Hi there. So welcome to Chapter 6, Capital Allowances. Um, Last week we looked at Chapter 5 where we were talking about adjusting trading profits. And if you remember, what we did was to start off with our net profits, if you like, and adjust for a range of things that we weren't allowed to have taken out. So we added those back in. And we had to take out things that shouldn't have been there, so certain sources of income that weren't allowed for trading purposes. And then, so if you like, less those, so those are net profits. We added back those things like depreciation that we'll see again in this. We took out other things. I should use a different letter here. And then we also said we had certain allowable, if you like, government depreciation, which is what we call capital allowances. We took that out as well, and we arrived at our tax adjusted trading profits. So what we're going to spend, if you like, the next 9 minutes looking at the first part, a couple of videos, maybe 3 or 4 10-minute slots, is looking at this this government grant depreciation equivalent in the next few minutes. Okay, great. So capital allowances, that's where we are. And again, like I said, because depreciation is not allowed, just because the government in itself, as you can imagine, for financial reporting purposes, yes, you may allow you may work out what we consider depreciation that's reliable and reasonable, but the government just don't trust it. And not just because they just don't trust it, because there are other reasons the government can actually, I will mention that somewhere else, the government can actually use it as a tool to encourage and discourage business behavior. So the key point here is the depreciation is not an allowable expense when it comes to computing taxable trading profits, and in its place, capital allowances are given instead. Now, these capital allowances are only allowed on certain qualifying assets. Qualifying assets, right? So we will look at what is considered a qualifying asset. By the way, first of all, I mean, it's just to help you remember now and then, buildings are never qualifying assets, the buildings themselves. So you may depreciate in your income statement if you wish, but when it comes to preparing your tax computation on your adjusted trading profits, we do not, the government does not allow buildings. Okay, great. So what am I saying? Capital allowances are available to people who buy plant and machinery. So really we're talking about things that are used, of course, in the trade, machinery, plant. And machinery pretty much is what it is. Trucks, any kind of machine that you're using within your business is perfectly allowable. Plant has always been one of those things that people tend to kind of have to go to court over, and we'll see a little bit about that later on. You might remember in Chapter 5 we said that once you decide to go with a cash basis, you're not allowed capital allowances, except on cars, because if you remember, cars themselves could not be put through as normal expenses. Remember, with the cash basis, capital and revenue expenses will go through as expenses anyway, except cars. So in that case, you're allowed capital allowances if you're preparing your accounts on a cash basis. So with a cash basis, you're not allowed capital allowances. And individuals who just go about their work day to day aren't allowed capital allowances anyway. So we're talking about trading businesses. Right. Again, how do we work out these capital allowances? Capital allowances are given on the original cost of the capital asset and everything that has added to its value of a capital nature. So if you bought an asset for £10,000 and during the year, if you kind of upgraded it and improved it, well, you are allowed capital allowances on yes, on the total cost, as long as it is considered improvement, as long as it's considered as increasing the value of that asset. And again, like I said, I did that earlier right at the beginning. You can deduct it in trying to arrive at the tax adjusted trading profit, and it is calculated for the period. So for example, if your period is from the 1st of January to the 31st of December, you will calculate your capital allowances for the 12-month period. We'll talk about the quirks in a second, but whatever your period is, you will prepare your capital allowances to cover the same period. Remember, it's for the it's really a matching concept, really. So however long your income and expenses are, your capital allowances are allowed for that period of time as well. Again, like I said, most people tend to be fine with machinery, plant. We tend to allow case law guide us. But what is definitely considered as plant is if you, because I said earlier on right at the beginning that buildings were excluded, but if you had to do something to your building, like alter the building so that you have your plant, the key point really is to do with the fact that whatever will allow the plant to reach its functioning point or to enable it to function, then we can allow we can allow this alteration as part of your capital allowance. And software, I guess the lobby group have come in there. So people who are buying software, acquiring software, that's considered plant. I guess because it can't be considered machinery. So that will fall under the context of plant. Again, I just highlighted buildings and structures cannot be considered as plant. So just watch out for that. And these are your typical examples. These are the kinds of things you're going to see: the computers, software, machinery, cars, lorries, office furniture, movable partitions, and we'll come back to this idea of why suddenly movable. And that's really to do because it's actually working, it's actually functioning, it's active, so to speak. Air conditioning, and like I said earlier on, alterations of buildings needed to install the plant and machinery. So again, this idea, capital allowances, the machinery or the plant has to have an active function. You're using it within the business. It's working, if you like. It's moving, which is why those movable partitions kind of pass the test. But if it's just sitting like a building, well, no, you can't. The government do not allow you to use that as will not consider that as qualifying expenditure, capital allowances. Right, so like I said, there are a couple of quirks, but what we'll do is I'll pause the video here. So that's really the introduction, all I've said so far. So capital allowances, part of your adjusted, tax-adjusted trading profits. You have a range of events, like I said, buildings and structures can't be considered, just little things that you need to remember there. And those are, I think, what's also important to remember the classic examples, because these are the ones you'll see all the time. What else was interesting here? Again, they're given on the original cost and all subsequent qualifying expenditure. And we're really talking about qualifying assets, and the aim is to replace depreciation, because we, of course, add back depreciation all the time to our net profit. And then deal with this. Okay, great stuff. So I'll stop there, and I'll see you in the next video when we start talking about the different pools.